Nicholas Bornois of Capitaling, and I'm delighted to welcome you to another great panel. Actually, this is a one-on-one discussion between two very senior industry participants. The topic is optimizing ESG and sustainability reporting, meeting regulatory requirements and market expectations and benchmarks. And we have with us Ms. Kiara Konti, Associate Partner of Climate Change and Sustainability Service at EY, and Janice Warren, Managing Director, Head of ESG Reporting Solutions at NASDAQ. So thank you very much for joining us, and I look forward to listening very carefully to your discussion.
Thank you, Mr. Bornozis. Good evening, everyone. Good afternoon, good morning. So Janice and myself will try to quickly go through the ESG trends, specifically on ESG reporting standards. I will touch upon the regulation developments both in the EU and the US, and finally we'll conclude with some recommendations for implementation. So I'll start with the ESG reporting standards universe, which is rather big or huge, some might say. The good news is that during the past, let's say, 2 years, there is great momentum and a lot of specific developments around convergence of these standards. So the aim is obviously to facilitate investors and other stakeholders to take more informed decisions on companies' performance around ESG. So the main events in these past 2 years have been started in September 2020, where the 5, let's say, most prominent ESG standard setters decided to announce that they intend to work together to achieve more consensus and convergence around these standards. This was followed with some additional developments. The IRC and SASB announced their intent to merge. And obviously, this whole discussion around ESG standards convergence and unifying the KPIs brings another discussion into play, which is how the non-financial and financial information can also be converged. Now, the most important development in this realm happened and was announced last year during the climate conference, the UN COP26 in Glasgow, where the IFRS Foundation announced the intent to develop the International Sustainability Standards Board, which will take the task upon developing the IFRS sustainability reporting standards. This again included a technical group which was based on, including again the main players, the TCFD, the value reporting framework, which was the old IRC and SASB. Apologies for all the acronyms, but it's how it goes in this realm. So also the Climate Disclosure Standards Board, the World Economic Forum, and the International Accounting Standards Board. So the main, let's say, takeaway from this is that the standards are converging. The IFRS specifically announced that in the second half of 2022, they will announce the sustainability disclosure standards. 2 of these prototypes have already been released, one on climate-related disclosures and the other on general requirements. So these are out there so companies can start assessing their readiness. And I think, Janice, if you want to add here some specificities on the trends and how we got here and some specific developments around the shipping sector and how it applies to these standards.
Sure. So let's start with some of the drivers behind the developments that Kiara described. First of all, we have unprecedented ESG interest by investors, financial institutions, and more E&S, environmental and social shareholder resolutions. And we have comparable expectations up and down our value chains. So customers, including cargo owners and others, employees, contractors, NGOs, and other stakeholders. And this momentum has already fueled significant alignment among key existing standards. So TCFD and SASB and other industry-specific standards, though I would say that 100% global convergence may remain elusive. There has also been a rise of industry-specific standards and initiatives In the shipping industry in particular, we have the Sustainable Shipping Initiative, the Poseidon Principles for financiers, international conventions, International Maritime Organization, IMO, and Seafarers Code of Conduct, and the Ship Transparency, the Ship Recycling Transparency Initiative. And layered on all of these, we have the rise of topic-specific initiatives, which may not be industry-specific, but topic-focused, such as diversity, equity, and inclusion, human rights, governance. And at NASDAQ One Report, we kind of know how daunting it is to keep up with this alphabet soup of frameworks and raters. So forgive some of the acronyms. As Kiara said, there are many. We also have investment and financial models and principles. In addition to the Poseidon Principles already mentioned, UNPRI, the Green Bond Principles, and networks like NASDAQ Sustainable Bond Network, connecting investors and bond issuers. And consequently, from all of this, there is very strong regulatory interest in both decarbonization and in other broad ESG expectations. So Kiara, if you want to share a deep dive on some of the regulatory trends in the EU.
Thank you, Janice. Just to give some background on the regulatory non-financial reporting scheme in the EU. So we have the non-financial reporting directive for some years now. This included large public interest entities over 500 employees. So more or less in the European Union, this directive has under scope around 11,000 companies in the EU. Whereas we're expecting now the new Corporate Sustainability Reporting Directive, which was a proposal and has been announced by the European Council. The scope gets a lot larger. So we have now all large companies in the EU, so over 250 employees. It also includes all listed companies in the EU regulated market, apart from micro under 10 employees type of companies. So one big change is the scope. It's much broader. Now the new Corporate Sustainability Reporting Directive, the CSRD, comes into effect in January 2024. The European Union is also developing a set of standards for applying in this directive, in alignment, obviously, with the global developments that we just mentioned before. Another important change for the new CSRD directive is that it requires external assurance of the non-financial information. So that's also very important in comparison to the current directive, which doesn't. There is also a very specific focus on the new directive under the double materiality principle. And I'll just touch upon this because it's very important, not just for reporting purposes, but also for strategy purposes around ESG. So what the double materiality principle brings into play is that when a company discloses or plans their strategy around ESG, they need to assess its aspects. So for example, in the shipping sector, the most significant impacts have to do with climate change, biodiversity, human rights, health and safety. So under the double materiality, each of these, if we take, for example, climate change, the companies should assess A, how their business model and activities affect climate change. So, for example, the emissions that they emit, the greenhouse gas emissions, and the whole discussion about reducing these emissions. But the other very important dimension is how climate change, the physical and transition risks of climate change, risks and opportunities, affect the company itself. So, for example, how the company has assessed how extreme weather events or more chronic weather events will affect the business model and activities moving forward. So this is a very, again, important development of the CSRD. I think these are the most important points. So Janice, if you want to also give us your view on the very recent and exciting developments just this week from the US.
Sure. So the SEC here has proposed a climate disclosure rule, quite extensive, 500-page plus. So there are 4 key elements of the disclosure requirements that are proposed. And a reminder that these are just proposed. There will be a 60-day comment period. and they could be subject to change. But they really were building on previous climate disclosure rules and guidance, and they are closely aligned with the TCFD framework, but are framework agnostic. So 4 key pieces: impact to business. As Kiara was just describing, material climate related risks, both past and potential, are important, including impacts on estimates, assumptions, or financial results. And they do cover the physical risks that you just described, the transition risks, which include both reputational and technology changes, such as alternate fuel adaptations, et cetera, and the company's process for identifying, assessing, and managing these risks. Second, climate governance and oversight by the board and management. Third, emissions. So both Scope 1 and Scope 2 GHG emissions must be disclosed. And Scope 3 is not applicable for smaller companies, but required for others if it's material, either quantitatively or qualitatively, or if part of a target or a goal. And then for all reported scopes, the totals for each constituent greenhouse gas is expected to be reported along with all GHGs, total GHGs in absolute and intensity terms, excluding offsets. And then finally, climate disclosure. So the underlying details of your climate strategy are required for 3 items only if they are set or applicable for the company: transition plans and scenario analysis, climate-related targets or goals, and internal carbon pricing. And then overlaying all of these, disclosures are expected to be addressed in any applicable SEC filing. They should be GAAP compliant. They should be measured. They should be assured by an independent licensed third-party provider for both Scope 1 and 2 GHG emissions and climate-related financial disclosures. And there is phased timing. So the earliest filer, large accelerated filers, the earliest deadline will be in FY 2023 for annual reports filed in 2024. Then later for other companies, assurance requirements will lag by a year with a phased shift from limited assurance requirements to reasonable assurance requirements. And certainly feedback is welcomed by the SEC. And there's one other SEC proposal that, or one SEC clarification that came through in late 2021 that I wanted to mention as well. So companies can no longer exclude shareholder proposals on time-bound climate targets based on the micromanagement argument. So as long as management maintains its discretion on how to achieve goals, those shareholder proposals need to go through, need to be considered. So Kiara, what would you say is the one takeaway for companies to better address these climate risks?
I'll respond to that, Janice, based on the recent results that we have from our the EY Global Climate Risk Disclosure Barometer that we're running for almost 3 years now. So what we're seeing is that companies that are adhering to the TCFD recommendations are improving these disclosures, both in terms of quality and coverage. But the one thing that definitely needs to be improved is the climate scenario analysis process. So we're seeing about 40% of the sample conducting scenario analysis, only 15 of those featuring climate change in their financial statements. So what is missing has to do a lot with understanding that climate risks and opportunities work a bit differently from traditional risk analysis, because we have to assess both different time horizons, but also different climate scenarios, so orderly, disorderly, and hothouse, and different in between. But the idea here is to make sure that you assess and develop the strategy in the entire risk framework based on different possible futures. So the transition risks and physical risk will change under different climate scenarios. And this requires excessive modeling specifically for physical risks in specific geographies, in specific scaling where the assets are placed. And specifically for the shipping industry, this is very relevant because the physical risks have not yet been so much identified and assessed. We see a lot of friction in the sector for transition risks and disclosure around reducing emissions, reaching net zero, etc. But what are the plans of the shipping sector for mitigating extreme weather events that might affect the routes and the voyages of their vessels? So I think that's an important takeaway, specifically regarding climate risk and climate strategy. And maybe you want to touch upon a few more recommendations?
Sure, and happy to talk a little bit about the kind of broader ESG recommendations. So I think a good place to start is for companies to assess their goals. Is it compliance? Is it keeping customers or investors happy? Is it market leadership? And to do that, you can also assess your ESG risks and opportunities, a really foundational place to start, and the impact to you, to and by your firm for all time horizons, as Kiara was mentioning before, which reflects strong corporate governance and builds resilience. Also tracking and learning from your peers. So peers, raters, and standard setters as part of this materiality assessment process. So as a starting point, if you consider and disclose based on several resources, number one, SASB. SASB standards incorporate topics and metrics tailored to the marine transportation industry and a manageable number of topics and metrics. TCFD is also a widely expected framework by some investors and heavily referenced by new regulations. And then finally, there are a number of industry reports that have been published that you can learn from, citing some cite challenges such as low board oversight on climate, lower ESG disclosure, different methodologies, rates of technology adoption, capital intensity, financing challenges, and cost of decarbonization, which some cite as perhaps exceeding $1 trillion for this industry. So if you focus on both the doing and the disclosing, sharing the numbers and the narrative for context, your disclosure depth and your breadth will serve you well, yield better performance, and sets up a self-reinforcing improvement cycle. If you determine what you need to continually improve performance, benchmarking, information, resources, technology, services, what do you need to get to where you want to go? And finally, I would say to retain your access to capital and support of investors and financial institutions and all of your stakeholders, you'll need to monitor, manage, and meet the evolving societal and environmental performance and disclosure expectations. Essentially, business as usual is not sustainable.
We have 1 minute left. I have a question for you, Janice. Are you optimistic about that this won't be just another tick the box exercise and that all this regulatory push to ESG disclosures will really move the agenda forward rather than just adding burden to the industry?
I think that's to be determined, and I wouldn't want to adjudicate on that. But I do think that it is part of this whole broader learning process that companies around the world are having because of this cacophony of voices to focus on this, on the decarbonization challenge.
I think so too. Mrs. Bornozis, I think we can also have your view here.
No, I wanted to say that this has been a great discussion, and if you want to take another minute or so, if you have any other topics or questions to cover, be my guest.
There was a question. Go ahead.
No, I think there's Is there a question from the audience?
Yes, there was one about scope 3 emissions and what will constitute material. And I think there are a lot of open questions about that. They're in the fine print. There's also mention of a 1% threshold related to specific line item financial disclosures in relation to scope 3. Or in relation to not just scope 3, for all disclosures, actually. So I think there's a lot to be clarified there, but the definition of materiality, given the double materiality and the SEC playing in this field, is always a challenging question and never fully answered in some ways, except by practice.
Thank you, Kiara.
Just one comment from my side. I think the whole carbon footprint discussion, scope 3 included, has in many cases should be framed around the ambition of the decarbonization agenda. So if the ambition is set in specific standards, like for example, the SBTI, the Science-Based Targets Initiative, then there are also specific requirements from the target setting perspective of what exactly you need to measure for scope 3 as well. So one should take into consideration the target setting framework under which the decarbonization ambition is set before disclosing scope 3 emissions.
Well, if you don't mind, we'll ask you for a closing remark, and thank you. I don't know if you have any closing statements before we go.
I think we made all of them. Just a quick one from my side. Hopefully this will not be just a tick the box exercise. We're seeing a lot of momentum from corporates trying to increase their robustness of the processes around this data to actually give them valuable information for the financial impact of this sustainability agenda.
That's right. And I think a lot of it's enlightened self-interest to be paying attention to what third parties are asking of companies, whether it's on the regulatory horizon or specific third-party frameworks. There's a lot of wisdom in that we all can learn from and take action on. And so that's the challenge and the opportunity.
Thank you to both for a great discussion, for a great insight, and also thank you to EY and NASDAQ for your support of the forum and involvement. Thank you very, very much.
Thank you for having us.
Thank you.